Will the stock market crash 70%? For many investors who did not witness the 2000 tech crash or the 2008 financial meltdown, the idea of the stock market declining by 70% can seem unimaginable. However, those familiar with market history understand that crashes and severe corrections of this magnitude have occurred before and could happen again. Historical precedents. Learning from the past. Looking back at market history helps put today's concerns into perspective. In 2007, financial experts and pundits speculated that both the stock market and real estate market had reached a permanent plateau. The markets were hitting all-time highs, but this optimism proved premature. The 2007-2009 bear market saw the S&P 500 plunge approximately 54–60% from its peak to trough. Crude oil prices surged past $140 a barrel in mid-2008, only to crash below $30 shortly afterward. History reveals that markets are cyclical and corrections of 50% or more are not unprecedented. For example, the Great Depression, 1929–1932, saw the stock market crash nearly 86%, with recovery taking over 2 decades. The 1973–74 oil crisis caused a near 48% fall in stocks over 2 years. The dot-com bust, 2002–2002, resulted in a 49% decline in tech-heavy indexes. These events underscore the reality that markets can and do suffer devastating downturns, often triggered by a combination of speculative excess, economic shocks, and geopolitical events. Why many investors today miss the risks? Most current market participants have experienced nothing but rising markets since the 2009 rebound. This long bull run, combined with ultra-low interest rates kept by central bankers like Ben Bernanke, has altered market psychology. Many investors now believe that this time is different, expecting markets can only go higher. However, veterans like Jeremy Grantham, a respected investor and bear market historian, warn against this complacency. Grantham highlights how markets always revert to their historical means, meaning that bubbles eventually burst and prices normalize. The policy of maintaining near-zero interest rates has disrupted the natural price discovery process, inflating asset bubbles across stocks, bonds, and real estate before their inherent risks are fully priced in. Increased leverage and its consequences. One significant difference between today and prior crashes is the heightened level of leverage in the system. Individuals, institutions, and governments are more indebted than during the 2008 crisis. High leverage increases vulnerability to margin calls and forced liquidations. When assets start falling, leveraged positions can accelerate the market's plunge. This could result in a more severe crash than we witnessed in 2008 or 2000. Leverage acts as a force multiplier in market declines, turning moderate corrections into potential panic-driven sell-offs. Expert predictions. A 70% crash is within the realm of possibility. Several top investors and analysts have publicly stated that a major crash of up to 70% or more in stock prices can't be ruled out. Jeremy Grantham has indicated a high probability of such a correction based on valuation extremes and historical patterns. Similarly, voices like Dave Collum emphasize that current market valuations and economic instability could cause significant market losses. The middle class will bear the brunt. Crashes of this scale disproportionately hurt the middle class, who have much of their wealth tied to equities and housing. Retirement savings, home values, and consumer spending power all risk substantial erosion. The 2008 crisis caused years of lost wealth and jobs. Recovery can take a decade or longer, as seen in the period following the dot-com crash. When will it happen? Timing remains uncertain. Although no one can predict the exact timing of the next market crash, historical cycles suggest the question is when, not if. Speculative bubbles inflate and burst repeatedly throughout history, always reshaping the economic landscape. Market psychology. The cycle of boom and bust. The belief, "it's different this time," is a common mistake in every bubble. Eventually, market sentiment changes, panic selling ensues, and prices fall towards their mean values. Investors who lived through the 2000 and 2008 crashes understand this pattern well. For example, the 2008 crisis began with real estate exuberance, followed by financial sector failures, steep declines in consumer confidence, and ultimately a global recession. Preparing for a potential market crash. Investors today must evaluate their risk exposure, reduce leverage, and diversify portfolios to mitigate potential losses from a severe crash. Key preparation strategies include maintaining cash reserves and liquid assets, diversifying into non-correlated investments like bonds or gold, avoiding excessive margin loans and speculative bets. The pain of a crash is often amplified for those who are unprepared. History and market experts caution that a major stock market crash of up to 70% is within the realm of possibility given today's economic, financial, and psychological factors. The key takeaway for investors is cautious preparation rather than complacent optimism. Markets have a repeated tendency to return to their mean, and bubbles eventually burst. Are portfolios ready for this? The middle class in particular must understand the risks and take prudent steps now to protect their financial futures. If you found this video insightful, please hit the like button and subscribe to our channel for more expert market analysis. Don't forget to share this video with friends and others who want to stay informed about potential market risks.